In the holiday-filled week, the rupee hovered in a tight range between 74.20 to 74.40, and the huge rise in domestic stocks influenced the domestic currency to rise, but fears of RBI intervention limited its ascent beyond the 74.20 level. Rupee is expected to maintain its stable undertone, and trading is restricted to 74.20 to 74.60 range till the end of this month. While the importers can defer to hedge their short-term payables, the exporters may need to sell their medium-term export receivables to derive a favorable exchange rate to enhance their export realization in the background of rising demand in the global markets. We believe the 74.00 resistance level for the rupee shall form the base for the short term and medium term, as we expect the Fed tapering announcement to be made before the end of December 2021. Rupee's down move to 75.50 at that point of time is a possible scenario. Our forecast of 76.20 to 76.50 level at the end of the current financial year, representing a depreciation of about 4% on an annualized basis from the closing level of 73.1050 as at end of March 2021, is still valid. India's July exports recorded USD 35.43 billion in July, followed by over USD 35 billion of exports in May and June. The growth in exports signify that global trade is recovering fast, and the order booking position of exporters have turned impressive. Imports also rose to $46.40 billion in July, which led to widening of trade deficit to USD 11 billion from USD 9.4 billion in June. The current account receipts are much higher to result in a higher current account surplus in the current fiscal. This, combined with the huge capital inflows received in the first quarter of the current fiscal, the BOP surplus in the corresponding period will be significantly higher, leading to a comfortable external position. The rise in non-oil imports, while reflecting the rise in global commodity prices, also indicates an increase in capacity utilization of manufacturing companies and rise in capex imports for new greenfield projects under implementation. The Taliban victory in Afghanistan and new COVID variants increased demand for the U.S. Treasuries. The 10-year U.S. T-bond yield fell to a low of 1.2170% on Tuesday in the earlier week, after weak Chinese data gave an indication that the global economic growth may be slowing. A slower global economic growth is having an adverse effect on the Asian currencies, backed by a steep fall in most of the Asian stocks. While the exports target of USD 400 billion can easily be achieved, guided by the current export growth, the central bank on their part shall keep the exports competitive to boost export growth. Thus, one can expect the rupee to hold the stiff resistance at 74 level. The forex reserves recorded a high of $621.46 billion in the week ended 6th August 2021, and the forex reserves will comfortably cover over 18 months of imports. India's dollar swap window, estimated at over $50 billion, may lift the forex reserves to much higher levels, enabling to meet any huge forex outflows arising out of Fed tapering expected to materialize by the end of 2021 and to support the rupee from any sharp depreciation beyond the 76 level at the end of the current financial year. In this context, RBI, supported by comments from reputed economists, may be unwilling to use part of the forex reserves for infrastructure funding. India's WPI inflation eased to 11.16% year-on-year in July from 12.07% in the previous month. The lower CPI and WPI inflation would keep the rupee broadly stable and maintain the 10-year sovereign bond yield at close to 6.20% level in the near future. Rupee is expected to trade sideways in the range between 74.20 to 74.60 up to the end of this month. The trigger for any rupee weakness is from Fed tapering announcement, which could take the rupee to not lower than 75.50 level, as strong intervention from RBI at that weaker level would support the domestic currency to retract to the 75 level thereafter. This is the view of most analysts at this point of time. But in the event the Fed decides to hike the interest rates within a gap period of 3 months or so from the Fed tapering timeline, it is quite possible to see the rupee weakening to 76.20 to 76.50 level before the end of the current financial year. We believe the huge forex reserves of the country would disallow any weakness in the rupee beyond the above said level, and the consensus market view also provides the guidance quite close to the above referred level of the rupee. The winning streak in Indian markets continued from the beginning of last week, with Sensex recording a lifetime high of 56,118.57 on Wednesday, while Nifty 50 also registered a high of 16,701.85 for the first time in history. Positive global cues swayed buying spree in Indian markets, with banks and financial stocks were lead gainers. But in the last 2 days of the week, BSE Sensex fell by more than 785 points due to sharp fall in Asian stocks and tracking the global cues. Inflation is expected to stabilize during the remainder of the current financial year, closely tracking the forward-looking mission statement from RBI for the path of inflation. The lower domestic inflation will also reduce the inflation differential between India and our major trading partners, leading the rupee to depreciate on a lower scale to about 76.00 mark by end March 2022 based on fundamentals.